the drywall we picked, you see there's a seam here because it's removable drywall. I picked it specifically so we could cost segregate it as 5-year property or 7-year property.
See how smart they are.
Superpower.
This is Kevin Bassett, my CPA.
What does that stand for?
We love some cost segregation.
What he's going to share with us today should help investors in commercial real estate or owners or even brokers tax-wise moving forward.
The deduction might be so large that you won't have to do a 1031 exchange and just buy another property and do bonus depreciation, reset your basis and not go through the time constraints of a 1031 exchange.
It would wipe out that passive income and you wouldn't pay taxes on that income.
And this is something that folks can still do for 2023.
This is Kevin Bassett, my CPA.
Your CPA, what does that stand for?
It's a certified public accountant, I think is what it stands for.
We're talking to an accountant today?
And aren't you excited?
Oh my goodness.
Stands for can't pass again. I mean, we can't pass the exam a second time.
Is that true?
I don't.
I mean, not like that actually, but you can only pass it once?
Well,
Yeah, well, meaning that I don't think we would score high enough the second time around.
it's kind of like taking your real estate license exam. Like you learn all this stuff, especially if you're on the commercial side of the fence. You learn all this stuff. It's almost all residential. You go take the test, and then you've flushed that information pretty much down the toilet. You never need it again if you're on the commercial side.
Sure.
It's probably 70-80% of it. I don't know that I could pass it if I just walked in and sat for it right now.
Yeah, I see.
Maybe it's I'm sure the CPA exam is much more difficult than the.
I'd imagine it'd be awful for me. Awful. How long have you all known each other?
Well, I got connected with Kevin through Rod Santomassimo. When I was at the Massimo group with Rod, we had Kevin come on and do some webinars. So like I knew right off the bat who Kevin was, and I'd heard him communicate. And he is, in my opinion, one of the rare CPAs that is actually a good communicator to the masses.
Oh, right.
You know?
Yeah, right.
And I remember Rod saying, he's got like a waiting list of 2-3 years, but I'll talk to him. I'll get you. I'll get you.
Oh, what a good guy. Rod, what a good guy.
He got me to the top of the line. And so Kevin, I think, has been working. I think this is our second tax year, so probably a little over a year. And it's been a great experience to work with someone who really specializes in what we do. And
right.
And Kevin, this might be a little bit of a good time for you to just tell us about like your specific business, what like who's your kind of prototypical client and what do you guys do?
Before we jump in, the reason we have a CPA here today, are we talking like because tax season is coming up? Because that bill is in Congress right now.
What he's going to share with us today should help investors in commercial real estate or owners or even brokers do things in 2024 and beyond that will help tax-wise moving forward. So, we are going into tax season.
Right.
But,
Okay, great. Cool.
Yeah.
Cool.
That makes sense. And, of course, we've talked about bonus depreciation before, and you have a pretty good understanding of what that is and how it's kind of phasing out. And there is a bill coming. Well, why don't we...
Yeah, but why don't...
any news about that?
Sure. Yeah. So that bill, it passed the House yesterday and is in the Senate. It's not a sure thing, but it's highly likely that it'll pass. And what it will do is make the 100% bonus depreciation retroactive to 2023. So even though we're here to mostly talk about 2024, that's still something investors could do for 2023. And it would extend it through 2025, which was the phase out period you were talking about.
And then at 2025, would it start to phase out again?
It would end. So bonus depreciation's been around in some form for now if you include the current president, 4 presidents in a row. It was Bush, Obama, then Trump. And so what happened, it existed and then went away, and the next president came in, it existed again, went away. And then, of course, in 2017 came back at 100%. Effective in 2018, and then was scheduled to phase out. So now it may continue at 100% until 2025, and then go away until they bring it back again.
All right. Well, that's potentially great news. Well, we'll get back to that in a minute. But yeah, give us,
A little background.
tell us who you are.
Sure. Yep. So I'm the owner of Bassett and Associates. Started the firm 24 years ago. I was previously with one of what they call the Big Four firms, working with the really large real estate funds, in some cases publicly traded REITs. Then started my firm, and we have team members all over, but we're based in Raleigh and have clients across the country. Our specialties are real estate and construction, and a lot of our clients are what they call syndicated funds, where they've done syndicates, and we also have large either institutional or individual investors with real estate portfolios that are either commercial or multifamily. Those are the two specialties. So it's been a lot of fun. It's a great world to be in most of the time.
That's right. Most of the time.
Yeah. Is there a reason that you went into real estate? Did you know somebody? Did it start that way?
Sometimes it's luck, but a few things happened while I was in college. One, I worked construction. It was one of my summer jobs, and that got me interested in construction. And then my internship was actually a real estate property management firm there. I went to University of Florida, so was there in Gainesville. And of course, it's one of those where you don't realize the education you're getting at the time because you're 21 years old and know it all.
Yep.
But it was a great education. And then, through some luck, when I worked for the big firm, got to end up working the real estate and construction group, and the rest is history.
Did you see the frown on my face
When?
when he said the University of Florida?
Yeah, that's right.
Oh,
Do you know what happened last night?
no. What happened last night, Bo?
University of Florida came into Lexington, Kentucky, where they haven't won in for dang ever,
Oh, no.
and they beat UK in overtime.
Oh, no.
Now, just because we didn't have two of our starters and whatever, we still lost the game. So unranked Florida beat 10th ranked UK at UK
Oh,
in overtime.
how do you feel about that, Kevin?
Nobody
Good,
cares.
'cause there's not been a lot of good news in Gator sports recently, so we'll take what we can get.
Hey, look, they were impressive last night. They really were. And
Thank it. Yep.
What a game.
And I don't think I'm positive when I was a student I never saw them beat you guys, so we'll take it.
Yay.
okay, let's move on to better topics. So we did just mention, bonus depreciation, and one of our first episodes, I was explaining to Timmy, buy a property, cost seg it, bonus depreciate it. But for Timmy's benefit, coming from a professional, and for our listeners, would you give us kind of a high-level explanation of how that actually works and why it benefits the investor?
Absolutely. So cost segregation is absolutely one of our favorite strategies for real estate investors. And as you explained in podcast number 2, you can take a property and basically break it into pieces. And
Y'all can watch that right here, by the way. Boop.
Yep, that's right.
Yeah, go ahead, Kevin.
Good one. And Bo, I got to give you credit. You got almost everything right. So it's
Almost everything. Almost everything. That means something I didn't get right, but that's okay.
But it's good news. So you can break the property into pieces. And for example, I'm in commercial building that we own, and we're 7 tenants. And well, if you can tell behind me, but the drywall we picked, you see there's a seam here because it's removable drywall. I picked it specifically so we could cost segregate it as 5-year property or 7-year property, excuse me. And
See how smart they are.
Superpower.
Yeah.
So it's like this Lego building we're in. But and so since we bought it and it was an existing building, you're able to take even land. This is one minor tweak from what you said. Land is generally not depreciable. However, if you do a cost segregation of an existing project, some of the land does become depreciable because of land improvements that already exist, which is your sewage that runs underneath the dirt. And then you got sidewalks and parking lots and landscaping that can do it. So cost segregation is really powerful because it takes generally 20 to 30% of the cost of the project and breaks it into this components that are shorter class lives. Instead of getting written off over 39 years, they can get written off over 5, 7, or 15 years. And with bonus depreciation, all those 5, 7, and 15-year components can actually be bonus depreciated in 1 year. And this is something that folks can still do for 2023 if they haven't filed the return yet.
Or in other words, if they own a building and they're getting rents and they're not actively managed, it would wipe out that passive income and you wouldn't pay taxes on that income. But the depreciation,
That's right. It can,
yeah.
So if you are not a real estate professional, which I'll talk about in a second, so a passive investor, this bonus depreciation would create a large tax loss, which would wipe out probably all of your passive income. It would also wipe out any real estate capital gains that you had in that tax year, can apply against that. So it can be very powerful if you have sold a property in the same tax year. In fact, the write-off, the deduction might be so large that you won't have to do a 1031 exchange. You can just buy another property and do bonus depreciation, reset your basis, and not go through the time constraints of a 1031 exchange. So we love some cost segregation.
Which is what we talked about on our call yesterday.
Absolutely.
Yeah.
About a potentially using that strategy to exit some properties that we have and recast it and not have to do it.
1031 exchanges are wonderful. You can defer that gain, kick the can down the road. However, with this cost segregation, it may actually be better to do that strategy instead of the 1031 in many cases.
Yeah, because Bo was talking to me before your all's call, just kind of where he's at and looking for a solution for what you all talked about, right?
Mm-hmm.
So that didn't even enter your mind when you were thinking through?
One obvious, and just to unpack this for people who are listening, like we've got some properties that I might want to sell, but the basis on them are basically zero. And so if I do sell, there's a huge taxable event. I got to pay cost recovery on what I've depreciated, which is, 25, 30%, 25%.
25% federal plus state, yep.
Plus state, yeah. So I think for us, that gets it to 30. And then on the appreciation of the property, I have to pay capital gains, which is 20% plus 5% in Kentucky. So 25% there for me. That's a huge taxable event. And those taxes would become due unless I do a 1031 exchange, which I really don't want to do.
Right.
So the whole purpose of the call was, what other strategies could we look at besides a 1031 that would make it actually make sense for me to exit a property that I think is becoming more and more obsolete,
right,
with more new product coming into the market, and allow me to kind of recast that capital in a tax mitigated way.
Right.
And
right.
that's what we talked about was, especially if this bill gets passed and we get back to this point where this year we have 100% bonus depreciation, then, that could be a really good solution.
Okay. Kevin, maybe you can help me out here, because it's the cost segregation study on the properties that you want to sell, right? Is that what we're talking
about? It would be on what I would buy next.
That's right. On the purchase.
Oh, gotcha. Okay.
And all that depreciation that gets cost segged into these personal property buckets of 5, 7, and 15 years, and then being able to bonus depreciate it all in 1 year would take this huge tax bill, and basically they would net.
It's even out.
Well, depending on what I buy, maybe they don't mean it, but it would really at least minimize it significantly, the taxable event that I would have.
Right. Okay. Yeah. And
what's great,
go ahead, Kev.
Put some numbers to an example. Let's say you bought a new commercial property for $10 million, just to pick a nice round number. If it's an existing building that's fully outfitted, that cost segregation loss could be between $2 and $3 million, 20 to 30% of the purchase price. So now, of course, you financed a percentage of that, and so that means you're getting a huge deduction relative to the amount of money you've put in.
Let me unpack that thought real quick. You might have borrowed 60% from the bank.
Yeah.
That's right.
And then brought 40% of your own capital to the deal.
Sure.
Right. But you get to depreciate all of it. Like you get the depreciation from the bank's dollars.
Oh, wow. Yeah.
Right.
And that's really what he just referred to, which is
and that's like,
that's a good deal.
Commercial real estate professional.
We hadn't really even gotten to that
point.
Okay.
Yeah.
Yeah. In the days, up to a few years ago, when interest rates were really low, a lot of our institutional fund managers were just bringing 30% equity and 70% debt in because rates were so low. So that meant for every investor's dollar, if an investor invested in a syndicate and invested $100,000, they actually were walking out of there with, in some cases, a $100,000 tax loss on their K1 that could offset their passive income if they were passive. If they were a real estate professional, meaning if they were a real estate broker or in the construction trades, they can use that to offset any other income as well.
Oh, wow.
So that's wonderful.
That's what I would need a refresher on. Was that? Yeah. Okay, cool.
We've talked about what a real estate professional is a little bit, but what's the rules?
So a real estate professional says that you spend at least 750 hours in the real estate trades. And so that means you're actively in some sort of a business or profession that you're involved in real estate. So that includes all your real estate agents and brokers and folks that work in the construction trades actually count as this.
Oh, wow.
Now, unfortunately, me as a CPA, even though my clients are real estate and construction, that does not qualify because I'm not actively working with the dirt and bricks and sticks. But and so you have to have at least 750 hours in the real estate trades, and the amount of time you spend in real estate is greater than anything else. So if there's a part-time agent that's maybe they did work 750 hours on a side hustle, but they have a full-time job in an unrelated industry that they're working 2,000 hours, they wouldn't qualify. So in a lot of cases, these investors, maybe one spouse is working full-time, but the other one is doing the real estate part-time, and they can get to that 750. We'll make that other spouse the real estate professional.
Oh.
So they can get, and that allows you, the advantage of being a real estate professional is it allows you to take losses in real estate instead of just going to zero.
Yeah, how about that?
How about that?
Best industry on the planet.
Yeah. It sounds
it is.
Yeah. That sounds about right. Well, okay. The best industry on the planet. If you're in it, it's good for the taxes and all that. I'm curious from a CPA's point of view. I don't know exactly how to word this question. Depending on how privy you are to the other side of the coin, where there is a lot of people that are, for example, so upset and we're trying to get Trump because he didn't pay income tax. And then he's flat out said, hey, that's how it is. Like, that's how the laws were written. That, that's true, but that's this, right?
Actually, what he said to Hillary was, and you can't get it changed because all your donors take advantage of this.
Oh, yeah.
I think that was his answer, but yeah.
Something like that.
Yeah.
Yeah. But that was a moment. Even Dave Chappelle talks about that moment of like, this is why he has such a backing. But what would you say to somebody, or maybe you can help me word this question, but it's like, what do you say to the people that think that is
taking advantage of the system?
Taking advantage of the system, make the rich richer, all that, those things that don't fully understand what's going on. And Bo gave me a pretty good answer when I had this question a year ago, about what commercial real estate, specifically the amount of jobs and opportunities that it can create for more and more people. But I'm just curious if you have any thoughts on that.
Yeah, and I'm in my profession, it pays to be very apolitical because I plan to be in business and make a ton of money regardless of whether the red team or blue team's in charge. But the ideas behind a lot of what's in the tax code is we do operate in a capitalist system, and they want capital to stay in the United States and to be invested in projects. And real estate, it keeps the dollars here in the U.S. and U.S. soils, provides a ton of jobs, and then the tenants of those properties then have businesses or homes and create a bunch of jobs and pay a bunch of taxes. So it pays to keep the dollars here in the United States.
Okay.
That's what this is designed to do. And as far as some of these advantages, let's take bonus depreciation since we were talking about it. The previous existence of bonus depreciation were bills written in 2003 and 2008. So you can look in, those were two presidents of two different parties where these rules existed. Then, of course, it came back in 2017. So it's existed in both parties. And whether or not it's the donors, that's a great question. Certainly, our system does involve lobbying, and the industry probably does a pretty good job of that.
Mm-hmm.
And it was written not just for real estate, that was in mind, but also owners of companies that were buying equipment. They can bonus depreciate those as well, as long as it's bought here in the United States and put in service in the United States, right? That's part of the conditions.
Ah, okay.
Yeah, I didn't know that.
Yeah.
And I think what I said a year ago when you asked me that was that the tax code is written to incentivize certain behavior.
Right.
And so, exactly what he was talking about, like they write it that way so that guys like us will behave in a certain way, which benefits
more people,
regardless of their socioeconomic, situation.
Right.
Like it may be the people that have frontline jobs working at these companies that are able to have a great place to run their business out of because a commercial real estate investor decided to buy that building or build that building or whatever. It kind of it benefits the entire economy and everybody in it, not just the rich.
Right.
Yep.
Right. Yeah. Okay, cool. Got it.
All right. So I have two main questions that I'd love you to address. One is, what strategies should investors, developers look at in 2024? And what are some of the most common mistakes you see that these type of investors tend to make?
Great questions.
Yep.
Absolutely. Yep. So a number of things. Number one, first of all, make sure you're doing a good deal. First things first is do a deal that's going to make money, and don't let the tax tail wag the dog. So I'm a entrepreneur and investor first, and business owner, and real estate is one of my absolute favorite asset classes, if not the favorite. But it's got to be a good deal, and then you can, if you're going to get good returns on that deal, and then you add some good tax planning, that's going to increase what we call the internal rate of return, which is the rate of return over time. And so if you got good tax planning, that increases your after-tax cash flow. Now, another important thing with real estate is there are a number of ways to make money in real estate. There's the rental income, which is the cash flow during the life of the property. There's the appreciation, which could result in a capital gain later. And then if you're a syndicate or fund manager, like a number of ours are, you can make money that way in certain fees. And of course, developers and the contractors, construction companies, they make money their way. So all those different ways are taxed differently. So one of the first things that's most important is have the right structure. You talk about common mistakes. One of them is to make their money in the wrong structure. Maybe it needs to be an LLC taxed as a partnership, or maybe it needs to be a corporation, either a C Corp or S Corp. And certain types of incomes needs to go into certain structures, because in the eyes of the IRS, that's either investor income, investment income, or what's called dealer income, which is taxed as ordinary income. So that's the next important thing. And then also a real important thing is plan ahead before you unload that thing in a sale. You mentioned before that one of your properties, you have a really low basis because you bought it for not a lot, and then you've owned it a long time, so you've taken all that depreciation. So on a sale, you have to pay what's tax on what's called depreciation recapture. So the year before the sale, no later than that, you need to do what we do with our clients is called a recap minimization strategy, where we're going to look at what's on that asset schedule and strip out the stuff that would get taxed at that higher 25% rate. And if it's, the tax law allows us to get rid of stuff that's no longer in service, and we can just on that one move, right, can save 5 points on that sale.
So what I just did last night was I printed off what'd you call it? Like the asset?
Yeah, the asset schedule.
The asset schedule. And everything on these properties that wasn't in service anymore, like the roof that was put on in 1990 by dad or whatever, like that roof's not there anymore. Like we have a new roof.
Okay.
So like I was able to cross that off. And I spent it took me like 30 minutes.
Oh, wow.
Just going through and thinking, is this still there? Does this exist? Is this in service? And I was just crossing stuff out to take advantage of this. And because I might sell it in 2024, like I have to do this for the 2023 tax return. So if I would have had this conversation with him, because this point is plan ahead.
Right.
If I would have had this conversation with him in May after my tax returns were done, like I wouldn't have been able to take advantage of that strategy if I sold the property in 2024.
Okay.
Because I have to do that. I forget what you call it again. What's the
Recap minimization?
Yeah. Thanks. See, he takes good notes.
Yeah.
The beauty of this strategy or strategies like this, doing a good structure and the recapture minimization is these are all things that it's just planning, takes a little bit of time. And no point did we tell you to go spend a bunch of money, right? And so we're not the CPA firm that says go buy a truck there on New Year's Eve to knock down your tax bill, because that money's gone, right? And
Yeah.
of course, in that case, in a depreciating asset. So we'll literally will never say that. A little bit of planning, that drives down your effective tax rate, and that's the way to do it.
And I've always wondered why some CPAs will say, go spend $1 to save 30 cents.
Terrible.
That makes no sense to me.
Right.
You know?
Right.
Now, it's easy to like the idea when somebody tells you to go buy a new vehicle.
Right.
Like that tends to be something that's easily accepted.
Right.
You know?
Right.
Yeah, that just makes no sense.
Yeah. It only makes sense to me if it's somebody else's money, right? If I'm in charge of a budget for my little desk group, you know, like that episode of The Office where it's like, explain it to me like I'm 5. Okay, well, you have a lemonade stand. Mom and dad give you this much money, but it only costs this much. So you want to go spend that money. So next year they gave you the same amount. Okay, go ahead and explain it to me like I'm 2.
Right. Yep, that's right.
Yeah. I got a question. Could you give us an example of when you say the right structure, like LLC or corporation? Could you give like a specific example that would be helpful to our listeners?
Absolutely.
Yeah.
So if it's a long-term rental property, generally that's going to be in an LLC, taxed as a partnership. The reason being the rules for deducting losses are better in LLCs, taxed as a partnership. And then if you're a fund manager receiving fees for certain things, those fees should go to the corp, but your interest owned in the building that is the rental part, you hold that in an LLC. So in that case, you need two entities set up. Another example, if you're a construction company, that you'll do in a corp, either an S corp or C corp, because the money flowing in is dealer income or ordinary income, and you run it through a corp, so you save the self-employment tax. So all these little things knock down your effective tax rate and cost you nothing. They cost about the same to set up and file a tax return. It's just the right structure could save a ton of money.
What if you're a commercial real estate broker?
As long as you're making decent money, most commercial real estate brokers run that through an S corporation.
Okay.
But they'll do all their real estate investments, or most of them, in an LLC, taxed as a partnership.
So when I bought the company from Dad,
Yeah.
I bought a bunch of LLCs.
Uh-huh.
I created an S corp to run the brokerage company out of,
Okay.
like he just suggested. And then one of his companies was a C corp.
Yeah.
And it took me, I don't know, 2-3 years to wrap my brain around this mess of LLCs. But when you hear him explain it, Dad knew pretty much what he was doing when he
Right.
set all that stuff up.
Right. Right.
And so it's been a big benefit to me, but it took me a minute to understand it all for sure.
Yeah.
Of course. That's what good tax planning is. Yep. And certainly in real estate, there are some years that you may wipe out all of your income, but that's not the name of the game every year. Some years it is. Name of the game is that over time, the life cycle of your business or your investments, that you're paying the lowest tax rate, effective tax rate over the life of the project.
You know, and that's a concept I really heard of first from you. I think in one of those webinars is that you try to get as many of your clients as possible down into the lowest tax bracket, not necessarily zeroed out, though that's possible
generally.
sometimes. But
Generally down as close to 20% as we can get over time. But yeah, having negative income all the time generally means you're not making money.
yeah, that's true.
Yeah.
Some of the time, may mean because you had a large cost segregation.
Any other strategies? You mentioned
another one that isn't as popular right now because Congress needs to extend the bill, but opportunity zones had its day in the sun where it allowed you to defer a lot of gain and and then make money on that project. And as long as you held at least 10 years, there were no capital gains on it. We certainly had some investors take advantage of that and do large investments in the opportunity zones. And what those are zones designated by the state that you're in. So the 50 states, or 51 if you include Washington, D.C., they designated areas that they felt were underinvested or underdeveloped or had low income areas where they wanted real estate investment to occur. So if you did that, you could roll a gain from another project, defer that gain to 2026, and it actually knocked a little bit of the taxation off of it, deferred it and lowered it. And then as long as you held that project at least 10 years, if it made money, you'd pay zero capital gains on that.
Wow.
So there were a number of those. There's a lot of talk in Congress of extending that. Last I looked, it had not happened yet.
I looked into those pretty hard.
Yeah.
The problem is around here, like there's not a lot of opportunities in opportunity zones. One of the qualifications was, let's say I sold something. Instead of doing a 1031, I would take that money and put it into opportunity fund.
Mm-hmm.
And then I think I had 6 months to put it into the fund. And then I have another period of time, maybe another 6 months to actually invest it into a piece of property. But then I had to increase the spend by double, I think. So I couldn't just buy something and let it run. Like I had to improve the property by the amount I initially put into it. So if I deferred $100,000 into an opportunity fund and then bought a piece of property for $100,000, then I would have to build something or expand something for another $100,000 to qualify for all these things he was talking about. And I couldn't find anything around here that made sense.
Right.
It was one of these, like his first point was, don't let the tax tail wag the dog.
Right. Yeah.
That was the advice I got there. Like I was really trying to figure out a way to take advantage of these opportunity zone funds. And we've got a CPA on the Kentucky CCIM chapter with us.
Right.
And he basically said, Bo, like, you understand it. I get it. But like, if it's not a good deal, it's not a good deal.
Yeah.
You know, it's got to be a good deal first.
Right.
You know?
Right.
And I just couldn't find anything that I wanted to try to take advantage of.
Yeah.
Around here. But
And Kevin, it sounds like that's one of the most common mistakes. Would you say that people are chasing the tax benefits that they could get, and then make some bad deals just for the tax?
That's right. Yeah.
Yeah.
And then sure, you can go to a cocktail party and brag how you never pay any taxes, but if that's true every year, like I said, it means you're probably not making any money, and you might be a bad investor, right?
Yeah.
Mm-hmm. Yeah. But yeah, opportunity zone, it made sense in some things where you go in and buy an older building and buy it cheap, but then you had to spend at least that much on the upfit. And in a lot of cases, the projects made a ton of sense. Then they were able to fill them and they make a lot of money and are going to do really well on the back end, but only if it's a good deal.
Yeah.
Well, what are some of the other mistakes that investors tend to make?
Sure. So structure's key. But then on top of that, bad record keeping can really cost you because the beauty of the tax code, whether you own a business or an investment, the deductions that are available to you are pretty far and wide. If you play by the rules, there's a lot. And we have a concept with our clients called pre-taxing your lifestyle. If you've got a business or you're an investor and that is your primary business, a lot of things that you're already paying for now suddenly become deductible simply because you're a business owner or an investor. So pre-taxing your lifestyle, so things like either the cost of your vehicle or the mileage or your cell phone or your home internet or the home office, all these things can become deductible. And these are dollars you're already spending. So you're not letting the tax tail wag the dog and spending money you don't need to spend. You're already doing it. And now they become deductible. So again, that lowers your after-tax income and helps your effective tax rate. So good record keeping can make all the difference.
Do you got any like hacks that surprise your clients when you're like, here's a way to keep your records?
Oh wait,
Easily.
let me reframe your question
Sure.
just a little bit. Timmy is a card-carrying SAG-AFTRA actor. All right. Variable income. When when you're on a project and you get paid, my guess is it's probably 1099 income.
I think so. Yeah.
So like you have to withhold on yourself and pay taxes yourself.
Yeah.
Like they don't withhold on you and
depending
stuff.
on the project. Yeah.
So like for somebody like him, what are some things he could pre-tax? Because a lot of commercial real estate brokers are kind of in the same boat. Like they're 1099 income, they're independent contractors with the firms that they work with. What are some things Timmy could do to?
Sure, and you're exactly right. We have some, they're getting paid by SEG on our client list, and sometimes it is a W-2, sometimes it's a 1099. But if it's a 1099, that's where the deductions come in. Unfortunately, the way the code's currently written, if your only income is W-2 income, there's just not a whole lot you can do anymore. In fact, in 2017, they eliminated miscellaneous itemized deductions. But if you're getting 1099 income, that's where you can take deductions against it. You just file it on Schedule C or have it paid to an S corp, depending on how much money. And that's where you can take out your travel and your vehicle and your cell phone and your internet and anything that is related to your trade and the trade of acting. They're eligible to take some of those deductions as well if it's to increase your capability and competency in that trade.
Right. So like, for instance, one thing that actors do is watch TV and movies to see what's going on in the market, to see, what's being made, what's happening, get more familiar with casting directors, projects that are being made, new directors that come out, what is shooting in my town, what's shooting somewhere else. And you go and you watch these things. So like a Netflix subscription, as funny as it may sound to anybody else, like it sounds like that's a possible write-off for a 1099.
Yeah, most likely in your case, and you'd want to go with a CPA that specializes in it. But I think you'd have a compelling case where I would not, even if I'm watching, The Accountants or Ozark.
Yeah,
that's right.
Yeah. Right off Netflix because
learning how to launder money for bad guys. Mm-hmm.
We had some funny discussions at our team meetings after we binged that during COVID.
I bet you did.
Great. Thanks for reframing that for me.
Yeah. All right. What else?
I think that's it. So main thing, great record keeping, get your structure right, and then cost segregation. Good gracious, if this tax bill goes through and we get 100% for some more years, I would venture to predict that this will help the recovery of commercial real estate, right? Because it really incentivizes plowing capital into these projects.
Right.
Yeah. I mean, look, as a broker, all my investor friends, if this bill passes, I'm calling them all right away. And I'm making sure they're aware of the benefits. And I bet half of them won't even know what I'm talking about.
Right.
Which gives me an opportunity to educate them and hopefully, inspire them to hire me to help them go buy more stuff.
Right.
So that they can, good deal, but then they cost seg it, bonus depreciate it, and wipe out a lot of their, this is something I meant to bring up just to confirm that I understand this right. Let's say my buddies who I'd be calling, they own companies, they're not real estate professionals, so they're going to wipe out their taxable income. But if they go buy a $7 million investment, they might be able to create $1.5 million of depreciation this year. All right. Well, they don't have that much passive income. So what happens to the rest of it? Let's say they have 200,000, and so all they can wipe out is 200,000 in passive income, but they've got another $1.3 million.
Right.
Is it wasted? Can you carry it forward? How's that work?
So it's a good question. So it'll wipe out their passive income, any other real estate gains they might have.
Sure.
But if they don't use it all, which they probably would not, because they're not a real estate professional, then that amount carries forward against any future rental profits that come through and the eventual gain when that project is sold. So it'll carry forward indefinitely and offset any taxable income from that project or other real estate projects.
Which is why it's so important to do it. Like, especially if this passes, it's so important to do it.
You can bank it for later, essentially, if you can't use it in any particular year.
Yeah.
But if this bill passes and that ends at the end of 2025, and it's not recast or resurrected and it just goes away, you've got a specific amount of time to go buy something, put it in service, cost seg it, bonus depreciate it.
Right.
Bank that depreciation and then use it over time.
Right.
And it could relieve the need to do a 1031 exchange. It could take your passive income down to zero. Or if you're somebody like me, it doesn't matter where the income comes from. Since I'm a real estate professional, I can wipe all that out. So conceivably, I could get to zero taxable income in a year by doing this.
Yep.
Right.
Yep.
Right.
And maybe even have carry forward, right? If the cost segregation is big enough.
Yeah.
And yep, and it's a great move. And as long as, like I said, we're trying to get our clients down to one of the lower brackets, not necessarily the lowest, but 20% or better. So it's a great move. And I think that plus the fact that interest rates have at least stabilized, they've calmed down and stabilized a bit. So it's going in the right direction. One other neat thing about real estate, we're all in agreement, it's our favorite business and asset class, is there's something called Section 199A that exists through 2025. It actually has a decent chance, a bipartisan chance of getting extended in some form beyond that. But what that does is says certain types of income are eligible for a lower tax rate. And in fact, under 199A, it says that certain incomes, which are pass-through business incomes and rental income, 20% of it is tax-free. So for example, if you had income, if you were in the highest tax bracket of 37%, if 20% of it is tax-free, that means the effective rate on that income is 29.6%.
Wow.
So it makes real estate rental income very, very attractive because, you make income with other people's dollars. You get to knock it down, the taxability of it, through depreciation. And then whatever's left over on that, it's eligible for 199A, which lops another 20% off.
Wow.
So if you get a great rental income project, whether it's commercial or residential or multifamily, whatever it is, the effective tax rate on that cash flow could be extraordinary.
Wow.
And you're generating it, you acquire that asset with other people's money, whether it was 60% or more. So it's a terrific asset class.
Still want to act?
I was just thinking of a good one-liner there about being an actor. I do have a question. What would you say is the threshold for cost seg as far as when someone should pay for it or not?
That's a really good question.
That's a great one. And the cool thing is there's options, which Bo even introduced us to some options. So I love when clients find things. So if it's $2 million or above, that's when I recommend you get an engineering firm, the assets. If it's less than that, what I recommend is there's some do-it-yourself options out there, and you can put it in Google, and there's DIYcostseg.com, or I don't know if I have that exactly right, but there's some good ones that'll pop up, and I've seen the reports, and for assets $2 million or less, they're absolutely good enough. Even on a $2 million asset, if it's generating a $500,000 deduction in year one, that's still pretty worth it to most people. And so
yeah, okay.
$2 million and above, though, pay the extra money and get the engineering firm.
Okay.
So you can defend it.
Cool. Yeah, that was a great question. Yeah.
Yeah, nicely done.
Yeah.
Insightful.
Yeah.
Yep, that's right.
You want to jump into a pop quiz?
Yeah.
All right, so Kevin, like I explained, we're going to lob 5 questions to Timmy. The rules are this. It does not have to be something that we talked about. All right.
Oh, nice.
Now, most of the time it is, okay? But if I'm being real honest, Timmy does too well on these pop quizzes. He really pays attention. He takes a ton of notes.
I got to say, this one, though, like this particular field with all the numbers, and this is one that's just, it's going to be harder.
You can see how scared he is.
I'm a little scared.
The reason I'm bringing that up is you, more than almost all of our other guests, are going to be well suited to stump Timmy.
Yeah.
So feel free, okay? Feel free. But maybe for this first question, which is yours, You can lob him a softball, and then we can go from there. So, question one, Kevin, what do you got?
Softball in your field, Timmy.
Okay.
One of my favorite actors. Who's the main actor in Ozark?
Jason Bateman.
You're really consistently great.
Thanks for that confidence.
Not only is he consistently great, but for the last 30 years, he's basically just played himself in every show.
Yeah, that's right.
Yeah. Usually he's a lot funnier than people think. And man, he seems to be always working.
Yes. Yes. Incredible director. Now, Buster, buddy. Buster.
Yeah. Couples Retreat. He was epic.
Yeah.
Oh, yeah.
Great.
He brings the PowerPoint over. I love that.
Buster, buddy.
That's right. He brings the PowerPoint over to talk his friends into helping him save his marriage. Yeah. Okay. Great.
I always wanted to be a cop. I had a Jason Bateman impression that I had for a while. It's just been a while since I did it. Anyway, that's where my brain just went. That's how I froze up, like in real life.
Mm-hmm. No problem.
Okay, Bo.
Yep.
Used to that.
It froze up. I didn't get to hear it.
Yeah, well,
It wasn't that good.
I actually froze up.
Gotcha.
Buster,
Gotcha.
buddy. Yeah. Hi. Oh, hi, officer. Yeah. No, I always wanted to be a cop, but I just don't. It just doesn't pay well. Oh, anyway.
You don't point a hypothetical gun at your therapist.
Right. Michael.
I told you I'd found the CPA with personality.
Yeah, you did. Yeah. You sure did.
My college roommate said I'm a encyclopedia of worthless information.
Yeah.
My wife tells me the same thing. She's like, your head is so full of useless information.
Yeah. Yeah.
I'm like, well,
Mostly movie quotes. Yep.
That's right. That's mine too. Yeah. I was about to say. Full of movie quotes.
okay, I'm going to get really specific here for question 2. All right, one of Kevin's points was have the right structure. All right,
Yeah.
and he mentioned a number of different scenarios, but I'm going to throw out 2. A long-term rental. What is the legal structure that is likely the best fit for a long-term rental?
Yes. I don't want to look at my notes, but I'm going to say my answer and then look at my notes.
Okay.
Okay. I think it was long-term rental. I want to say LLC, but I think I'm wrong.
Well, no.
No, LLC.
But you need to be a little bit more specific than that. So,
Yeah. Okay. I'm looking at my notes real quick. Long-term rental. Was it LLC? Yeah.
taxed as a, say, partnership.
Oh yeah, tax as a partnership.
There you go.
Yeah.
Partners.
All right.
Okay.
So, second part of this question is, what if you're a commercial real estate broker?
Yeah.
What is the structure right for you, assuming you're making some pretty good money?
Well, yeah, it'd be S corp,
Yeah.
but your investment should be LLC,
Yes.
right?
Yeah, man.
Exactly.
Hey.
Nicely done.
And I couldn't tell you the difference between S corp and C corp. By the way, what's the
Ask him.
difference?
Sure. Yeah. So S corp, the income flows directly to you and your 1040, whether you take the money out or not. So S corp makes sense for your operating company if you're taking that money home to live on, right? You save self-employment tax, only one layer of tax, very efficient.
Okay.
C corp pays its own tax, and it makes sense if you got extra money that you're going to keep in the C corp and not take home.
Oh, gotcha.
It only pays tax at 21%. So if you're in a high bracket and generating a bunch of extra income, we'll have you set up an extra C corp, maybe a management company or something, to keep and retain that money at a lower tax rate.
Gotcha. So,
The
okay.
issue with a C corp though is
Yeah.
it's hard to get that money out, because if you take it home, it gets taxed a second time.
Oh,
Take
right.
it as a taxable dividend. That's right.
Yeah. So you really want to make sure that that's going back into the business, essentially, right? Yeah.
Yep. And then have a very clear method of how you're going to get it out. And there's a few tricks there. It can be borrowed or, or you sell or liquidate under Section 1202. A little bit beyond the scope of this podcast.
Right.
It's a good one.
Yeah.
And you eliminate that double taxation issue.
Oh, so that's how somebody would borrow money from themselves. Like, I've heard this about Elon Musk. Like, he borrows money from his, I might be wrong with that, but you know, you hear all these clips of like these big money guys that wake up at 3:30 a.m. so that they can go cold plunge for 2 hours and get home before their wife wakes up after having a workout. That's like, you don't need, you know, stop working to get money. Have money and borrow money from yourself. You know what I mean?
Yeah.
Yeah. Anyway.
Yeah. You can't borrow it personally, but your other entities can. And
Oh, okay.
doing a business-to-business arm's length promissory note, it can be done.
Okay.
But 1202 is the main way we get money from C corps at the end after it's been in there, and then you eliminate double taxation. It's a good trick. Different podcast though.
Yeah. Okay.
All right.
Yeah.
Yeah. When we have you back on, we can dive into
Yeah.
that.
Thanks for stopping.
Yeah. All right. Question 3. Kevin, what do you got?
All right. So what's the name of the technique when you're going to sell a property? You don't want to pay too much depreciation recapture. What's the name of that technique?
We're kicking the can down the road? No. Okay. Say it. Will you ask again?
So when you sell a property and you've got a lot of accumulated depreciation that you've taken from cost seg and own it a long time, if you sell it, you have to pay a higher tax rate on recapturing that depreciation. What's the name of the technique to minimize that hit and lower your tax rate?
Great question.
Do you want a hint?
Yeah, give me a hint.
Earlier when he mentioned this and I talked about I just did it last night,
Yeah.
I couldn't come up with the name and you did.
Yes, I know. It is, take a deep breath, Timmy. This is where music plays in the edited podcast. Yeah, wait. Recap minimization.
That's right. Yep.
Woo!
And when
Thanks.
do you need to do it?
When do you need to do it? You got to do it before you do your taxes. Before you.
Yeah, the tax year before the sale.
Yeah, that's actually what I meant. Oh,
That is
before
correct.
the tax year before the sale. That was not. Yeah. Okay.
So you kind of, I mean, you answered off of my example.
Sure.
Like we're in 2024 right
Right.
now, right?
Right.
But Kevin and I are working on my 2023 taxes. So I have to get this done in the 2023 tax year.
Yes.
I'm working on it in 2024. If I sell the property this year in 2024 and we've done this work for my 2023 taxes, I'm good.
Yeah. Gotcha. Good question. Good question.
Okay. There are 2 main rules that Kevin mentioned that qualify somebody as a real estate professional.
Yes.
What are those?
750 hours. And if
A year.
A year.
Yeah.
750 hours a year. Or, not or. 750, and you have, real estate has got to be, you got to be working on real estate more than any other job that you might be doing.
Yep. So 750 hours a year and 50% plus 1 hour
Yes.
of your time is real estate.
Right.
Yep.
Perfect.
Cool.
Nice.
Sweet. Was that all? Was that
That's
all?
4.
4?
Now,
Final?
we each gave you a 2-parter, so it might feel like that. But
Oh,
Kevin,
yeah.
right here, he has the 5th and final question, which I encourage him.
Yeah.
Which I encourage him to, give you a zinger.
Do me a zinger.
Sure. All right, let's go for it. What's the code section that knocks 20% off of certain types of business and real estate income to lower your tax rate by 20%?
199? 1099? A. Wait, 199A?
Wow, nicely done.
I'm telling you, man. He
And
that expires when?
Bo showed me his notes.
It expires by the
No, wait.
It expires 2025.
Yep, at the end of 25. Yeah.
Yep.
But that one appears to have a chance of continuing in some form, and we hope it does.
Yeah.
Yes, we do.
Yes, we sure do. We sure do. Oh,
Yep. And Yeah, final things is as scheduled now, tax rates are supposed to go up in 2026 to what they were previous administration. And one final piece of advice to all business owners and real estate investors: keep a mileage log. It's worth a lot of money to you. And they not only does it result in a nice deduction, it is a 100% guarantee they're going to ask for it in an IRS audit.
Oh,
Keep that mileage log.
okay.
Okay, well, let me ask you this. Like, what are the top 3 tips? Like, what needs to be in the mileage log? Like, what's the easiest way to accomplish that?
Yep, date, where you went, and a mileage amount. And the cool thing is, I've defended probably over 500 IRS audits at this point in my career, if probably a lot higher. And they always ask for it. The good news is they don't spend a lot of time on it. It's like you have it or you don't. And and I'm not going to claim that 100% of my clients are great about keeping a log every day, but I will say that 100% of the audits I've defended, we made sure there was a mileage log. So
Yeah.
that would do well.
Great pro tip. That's a great pro tip.
That's really great information. Well,
Awesome.
Kevin, where can people find you? Like, if they want to reach out, how do they?
Our website is BassettCPAs.com. And let us know. You can get on our email list. We invite you. We do webinars during the year, and a lot of those, not all of them, but many of them are open to the public if they're on our mailing list. And
Great.
it may make sense down the road if for us to be your CPAs if you're kind of grown to a certain amount of size where our strategies would be useful for you.
Cool. Putting that in the show notes, y'all. Putting that in the show notes. If you're watching on YouTube, hit subscribe button. Thanks for watching. Leave a review.
Kevin, thanks so much for joining us. We really
Thanks
appreciate
for
you having
me.
on.
Always a pleasure. Hope you have me back.
Yeah.
Absolutely, we
back.
will. Yeah. Yeah. Thanks, Kevin.
Yep, our pleasure. Thanks.
All right, man. I'll see you.
Bye, Alice.
Bye, Alice.
Bye. Hey. Thanks for tuning in to Commercially Speaking. If you're watching on YouTube, please hit subscribe. If there's anything specifically that you'd like Bo to teach me, and you as well, please put it in the comments right now. If you're listening on a podcast platform, please consider taking the time to leave a review. It really helps in this world. If you want to watch another episode, you can click right on the screen here and check back next Monday for a brand new episode of Commercially Speaking. Bye, Alice.